Hey, I'm here to share a quick tidbit with you about mortgages and other simple interest loans and explain to you how they're calculated, how you can save a ton of money, and how you can make extra payments to cut down the life of that mortgage. When you have a mortgage, let's say a $100,000 mortgage at 4% interest, the way that's calculated is 100,000 times 0.04 divided by 12 is the amount of interest that you owe each month's payment. Now on a $100,000 mortgage payment at 4%, you're talking about $477 a month. Of that, the first payment will only pay $144 toward the principal and $333 towards interest. As you go through that, each month the amount that is calculated is recalculated on that new balance. So the 100,000 minus the 144 times 0.04 divided by 12. And so we go on. After about 3 to 4 payments, you're going to gain $1 or $2 on your monthly payment. So now you're going to get 145 towards principal and 332 towards your interest. Here's the little trick, and most of us have heard, hey, if you make an extra payment, if you make an extra half payment, if you make an extra couple $100 a month, you will be able to pay down your mortgage much faster. And here's why that happens. When you make an extra payment to your mortgage, it slides you down that scale and it's recalculated on that month's balance. So let's say, for example, you make an extra $500 payment. That will slide you forward about 3 payments, at least at the early part of your mortgage loan. And here's the beauty of that. You actually save about $999 worth of interest. And guess what? You don't ever have to go back and pay that because the new payment is calculated on your current balance. So every time you can add a few hundred, even 1,000, maybe a couple thousand, as you go throughout the years, it really rapidly moves you forward. Let's say over the course of the first year, you've made an extra $1,500 worth of payments. That would actually have slid you forward about 2 years in your schedule. So a few hundred extra dollars will slide you a long way. This is one of the reasons that I recommend, and many other voices on finances recommend, a 15-year mortgage. It keeps your payment fairly reasonable, not a lot more expensive. You pay so much less in interest. You can save about $100,000 in interest over the scope of a 30-year mortgage versus a 15-year mortgage. Now that's on a $200,000 mortgage, not a $100,000 mortgage. This is a big deal. So anytime you have an extra few dollars and you're able to apply it to principal, it absolutely helps. It makes a big difference. This is the same reason that when you have a car loan or a credit card that you're trying to pay off, it's very, very important to scrape every penny, every dollar you can and throw it at it as soon as possible. Don't wait, because it keeps the interest payment lower for the following month. Now there are some crappy products out there that are not calculated on simple interest. They're called prepayment penalties. You'll see this on very, very high interest car loans or possibly on 90-day same as cash type deals. You want to be very, very careful when you are looking at taking financing, which I do not recommend, by the way. I recommend living no debt. But if you are taking financing, make sure you watch out for this quick pitfall. Make sure it's calculated on simple interest and that there's no prepayment penalty. Most mortgages, if not all mortgages, are set up this way because they have federal regulations around what kind of loans can be written. By the way, just a quick note here, if you have an adjustable rate mortgage, please refinance that to a fixed rate. Those adjustable rate mortgages are really bad news because what will happen is that interest rate will jump up and then the amount that you're paying will have to go up as well if the same amount of principal reduction is going to be able to happen. As always, thank you so much for watching this video. I hope it's added lots of value for you.